while the title of the book is, the hands-off investor, you're hands-off to the respect that you don't have to touch the real estate, but there's a period where you need to be extraordinarily hands-on, and that's when you're choosing who you're going to invest with.
Welcome to the Threefold Real Estate Investing Podcast. This is the podcast where you'll not only learn how you can achieve massive success in multifamily real estate investing, but also how you can simultaneously pursue great relationships with your family and a better walk with God. You can achieve financial freedom through real estate investing without sacrificing the relationships that mean the most to you. Now, here's your host, Lee Yoder.
Welcome back, Threefold listeners. I hope you're having a great week. Got another great guest today, somebody I've been following for a long time, currently a good way through, a great book that he wrote. If you're in multifamily at all, if you're trying to learn about multifamily, you know Brian Burke. Been on Bigger Pockets. He's a speaker at many of the conferences. So really excited to have him on today. He is the president and CEO of Praxis Capital, a vertically integrated real estate private equity investment firm. He's out in California, just north of San Francisco. He's acquired over $800 million worth of real estate over a 30-year career, including 4,000 multifamily units, more than 700 single-family homes, with the assistance of proprietary software that he wrote himself. He subdivided land, built homes, constructed self-storage, but really prefers repositioning existing multifamily properties. He's also the author of the book I mentioned I'm reading, The Hands-Off Investor. Brian, couldn't be more excited. Thanks so much for joining, man. I'm sure you got better things to do, but thank you for jumping on the podcast today.
Nothing could be more fun than this, Lee. I'm happy to be here. Thanks for inviting me.
Yeah, cool. Well, thanks, Brian. Well, there's a lot I want to get into, but if you don't mind, could you take us back? I guess just why did you get into real estate in the first place? And then I know you were really more on the single family side, but then why the transition? Why are you kind of, and you've done a bunch of things, but as reading your bio, you're really kind of, multifamily is your focus. Why into real estate in the first place? But then why is multifamily specifically your focus today?
Well, real estate in the first place was because of no other options. What else was I going to do with my life? I was, I knew that I wanted to try to find a route or a road to personal wealth. I knew trading my time for dollars wasn't the most likely way to get me there. I wasn't educated to be anyone else's star employee. So instead, I read a book that said that you could invest in real estate even if you had no money and you could become wealthy. And I thought, well, that's me. I have no money and I want to become wealthy. So I guess I need to invest in real estate. So that kind of got me started on the real estate bug. And, I started in flipping single family houses. And
Brian, where were you at that point? Like, what was you had a job? What age?
Yeah, I was like right after high school. I was 20. Yeah, I was 20 years old. And at the time I first got started in, I was working in a grocery store as a grocery store clerk, making $13 an hour and living off of the overdraft protection in my checking account because I needed it before the next paycheck would get deposited in my bank account. And then, I made my first real estate investment, while I was still employed in that grocery store. And shortly thereafter, I left the grocery business and got into law enforcement, and I was working at a local police and fire department for about 14 years. And during that time, I was usually working evenings and weekends, which left me the business week off. Yeah. And I would use that time to, figure out how to build and grow my real estate investment business. And so I was kind of doing that as a side hustle, and then finally got to the point where it was successful enough that I needed to hang up the job or it was going to get in the way. Yep. So went to full-time investing in real estate, just really mostly flipping houses. Then I started doing some single family residential construction where we're just building houses on existing lots. And then kind of floundered my way around in like every sector of real estate you could imagine: commercial, self-storage, single family development, kind of did everything, trying to figure out what I was best at. Multifamily as well was one of those things I got started in after doing a 1031 exchange of a couple of rental houses I'd collected.
Okay.
And kind of that was where it was until the economy just collapsed in 2008, and then led me down this path of, how do you deal with something like that? Do you shrink and crawl into a hole, or do you grow your way through it? And I choose to grow my way through it, and our business just exploded. I mean, we were doing 100 houses a year, and
wow.
And it just it got insanely crazy.
Yeah. And then, okay, well, first, Brian, what I love about your story too is like, like they say, real estate is not a get rich quick scheme, but it is you can get incredibly wealthy over a long period of time, and it's not guaranteed, but it is a proven concept. And your story is a good picture of that, because if I'm tracking you right, you got into real estate while as a grocery store clerk, so got your start, but then moved to police fire department, and you were there 14 years. So for 14 years, you were kind of building your first real estate little empire, which allowed you in portfolio, which allowed you to quit. So 14 years up to that point, right? And then since then, almost another 20 since then to where you are today. But like, it wasn't overnight, but you stuck with it, and it proved to be incredibly fruitful.
Yeah, this business rarely produces success overnight, especially a success at a level that is sustainable, repeatable, scalable, and really makes you a living. I mean, there's 1,000 stories out there of what you'd call an overnight success, where, somebody they bought, they got into real estate investing, and 2 months later they bought a 20-unit apartment building. They're massively successful. Well, that 20-unit apartment building might not cash flow. Right. They don't even have the money to fix up the units. They're struggling to collect rent. They can't find a second deal, but in everybody's mind, they're like enormously successful. And really, success comes from being able to repeat these things and actually produce tangible results and make a comfortable living for you and your family. I mean, that's what really, to me, defines success in this business, not just, look at this big property I bought.
Right. Absolutely. So Brian, through your story, you tried a bunch of different things, but it sounds like you really landed on multifamily. You mentioned like you were trying to figure out what you were best at. So I'm guessing that was part of it, where you feel like that's what you're best at. So I'd love to hear a little bit more about that, but then also just maybe why you think multifamily is just really a great place to invest your money.
Well, I'll start with the second one, and then I can get into why I felt I was good at it. It's a good place to invest your money because it's a scalable business. You can invest money in all kinds of different things, right? And I can't sit here and say that multifamily is better than any other real estate sector, better than any other financial investment. There's some really incredible business startups, stocks, all kinds of things out there that can be phenomenal investments. But real estate has a lot of very favorable characteristics for investors. It has tax advantages. There's tons of real estate out there. So that means that there's all kinds of different flavors, that you can invest in, and that makes it interesting, and it makes it so that you can do different things as the market dictates that different things are warranted, as opposed to just doing the same thing all the time. So, real estate has some distinct advantages as a result of that. And primarily for us, when we were flipping tons and tons of houses in this, back in the economic collapse and, in the mid 2000s, that was a period where, there were hundreds of foreclosures for us to pick off, pretty easily. And we were raising a lot of money to, do the volume that we were doing. Cause in California, let's face it, houses aren't cheap. Even then they weren't cheap.
Yeah.
And so it took a lot of money to do 100 houses a year, you can imagine. So we were raising all this cash, and it's like, okay, well, all these foreclosures are going to be gone one day. And, and then what are we going to do? What happens then? And multifamily, the advantage that we had is that could be a big business. In a house, you can buy a $100,000 house, or you could buy a $500,000 house. But in multifamily, you could buy a $1 million building, or you could buy a $500 million building. So you literally can scale the size of your acquisitions to the size of your investor base. And we knew that as we were raising all this money, if we wanted to be able to keep, these investors happy and investing their capital into viable investments, we needed to find something that was scalable like that.
Yep.
And we found through doing it that we were really darn good at it. And, we were good at flipping houses, but we were even better at producing results in multifamily. And I found that every time I venture outside of my lane, it doesn't go well for me. I never really had massive success in self-storage or mobile homes or, commercial and all this other stuff. We've had a lot of success in multifamily. And so that's what we're doing.
I appreciate that rundown on multifamily and couldn't agree more. I guess, reading your book, Brian, and I hold it up. I always read on Audible because I'm multitasker. So I always want to be reading, listening to a book while I'm running or something like that. So I don't have it to hold up, but we'll put it in the show notes because it's a great book, especially if you're, considering getting into multifamily investing. If you're hearing what Brian and I are talking about and you think it would be a good place for you to put your money, which, we would agree with that. It's a great book to read because it's called The Hands-Off Investor for a reason. You're going to be hands-off. You're going to be counting on somebody else. You're going to be putting your faith in somebody else, giving your money to somebody else to make a good investment of it. And then you're going to be hands off. I mean, you're going to, there can be a lot of transparency, but you're not making the decision. So, Brian, that being said, maybe just a couple of highlights from the book on how do you find a good person? So how do you go out and find somebody like you, Brian, that is good? And you're telling us you're good, but what about your prospectus and the stuff you put forth might tell us that you're good? Or maybe how can we go about finding out if you really are good, Brian, if you are as good as you say you are, and that we should really put our money with you? Maybe just a few highlights from the book along those lines.
Yeah, I think, one of the most kind of important things you said there is about, hey, if you're going to invest passively, you're hands off. You're not making the decisions. Mm-hmm. You don't have to do all the work. You're relying on somebody else. All of those statements relate to one concept, basically, is that you're putting your faith in someone.
Right.
To do a good job and make good decisions and make good investments and employ the right strategy and the right type of financing and all those different things. And choosing who you're going to do that with is anything but passive and anything but hands off. Yeah. So, while the title of the book is, the hands-off investor, you're hands off to the respect that you don't have to touch the real estate. But there's a period where you need to be extraordinarily hands-on, and that's when you're choosing who you're going to invest with, and doing the due diligence on them is a difficult process. And it's somewhat like, getting married. And, if you're going to give somebody, marriage and dating advice, it's like, okay, the first piece of advice you would probably give is don't go to the bar, find someone that's attractive, and then go straight to the marriage place down the street and get married. That's just not how it works. I mean, you get to know the person, and you'll probably get to know them over a long period of time, and then maybe you live together, and then maybe you get married. There's a process, right? And investing in a passive real estate syndication is a very similar process. I had a guy call me one time, and he said, we had this long conversation asking about what we do and this and that, and I asked him, well, what is it that you do? And he told me, I'm the money manager for, the richest man in this state, the state that they were from. And he said, and we're looking for investment opportunities for the family office. And he said, so, I'd be interested in getting some information on your latest investment and getting on your list to get all the future investments that you guys do. And he says, we'll watch that material. We'll review that material, and we'll watch your progress over the next couple of years. And then we'll decide whether we want to make an investment or not.
Yeah.
And emphasis on watch for a couple of years, right? So they want to see that we buy something. They want to see, how the performance is after we've bought it. They'll check in with us in, a year. Well, how'd that deal go? Did that go according to plan? And, so we'd have those conversations. And it's you have to really spend your time asking questions, reviewing materials, looking for things that make sense. I mean, from the very simplest thing, if you've got an investment prospectus that's loaded with spelling errors and grammatical issues and mathematical errors in the numbers. I mean, that just tells you right away they're not paying attention to detail. And, those are things that you can just toss out, right away. That's the simplest, quick pass. But there's so many more things to look at in terms of how they're underwriting, how they're approaching the business, how they're thinking about the plan for this investment, and don't be in a rush to invest in the first deal that they show you. It's okay to see one of them and get familiar with them and wait until the next one comes out before you invest. Just don't be in a hurry.
Yeah. One thing I always feel like I'm pushing people toward, and I think you talked about it in the part of the book that I've read so far, is that, referrals. I mean, it's a great, you want to find out what it's like to invest with someone. We'll talk to somebody that has. Is that something you typically recommend to people?
Absolutely. There's no better way to get in with, a syndication investment than from a friend that and trust that has invested and who has preferably seen some results too. Not just like, oh, hey, I invested in this deal, you should invest in it, when they've never invested with them before. And maybe they didn't even do any due diligence. But if you've got somebody that's like, oh, we've gone full cycle on a couple deals, I made this much on the last one. And, and that's a really valuable recommendation and definitely something to pay attention to.
Yeah. Brian, I'd love to talk a little bit because I know being in the business for a while and hanging out with the people that you do and being at the conferences, I know you've really got your finger on the pulse and being the high level, a CEO of a big real estate investment firm, you're, constantly with your finger in the air trying to figure out, where the wind's blowing and what's going on and what's the Fed going to do? How's that going to affect things? So if people are interested in investing in real estate, they might be thinking that now's not a good time because it seems scary out there and interest rates have risen, percentage wise faster than ever. And maybe we're headed for a recession. So what are kind of your thoughts right now? Or just even like, what's the framework? How should they think about that? There's people that say, you can't time the market. So, kind of the stock mentality, like you can't time it, right? That your stockbroker is just going to tell you there's never a good time to sell. And you just always put money into it, right? Because if things are going well, hey, look how well things are going, like keep putting money in. And when things are going bad, hey, everything's on sale, keep putting money in. So can't time the market, but at the same time, we should be diligent, right? About, well, there might be some favorable times. I mean, if you started in 07, probably didn't go too well for you. If you started anytime after, 9, 10, you've had a great decade to 15 years. So there's something to be said for at least having your finger on the pulse. I know you do. So maybe let's dig into that a little bit. Whatever, you're seeing or whatever you'd like to share. I'd love to kind of have that conversation.
Yeah, well, if anybody is saying, geez, now doesn't seem like a good time to invest, I would tend to agree with them, which may sound surprising from someone that's in the business of, recruiting passive investors for the purpose of investing in real estate. Right now, I mentioned to you, just before we started recording this show that, I'm watching the game from the grandstands right now. In my view, there's really no reason why I need to make any real estate investment right now. That doesn't mean real estate is bad. It just means that there are times to get in and there's times to get out and there's times to watch and wait. And in my opinion, right now is one of those watch and wait times. There are people out there who say you can't time the market. I think I'm living proof that they're wrong. I stopped buying real estate in about 04, 05 before the collapse. Had sold most everything I'd had, and then started buying heavily in 08, 09 after prices fell by 60%. So you can't tell me that you can't time the market. If you're paying really close attention, you can, in fact, time the market. We just, over the last 18 months to 2 years, I've sold about 2,500 units out of our portfolio, which comprised majority of our portfolio. We only have less than 1,000 units left. We sold almost everything at great prices at a great time, and now we're waiting, and then we'll jump back in when I think conditions are right. So you can, in fact, time it, and if you mistime it, you can be in a world of hurt. Somebody that bought something in 05 and went all in probably ended up bankrupt. Frankly, ended up bankrupt. If they didn't, then it's a miracle.
Yeah.
It's very important to pay attention to what the market signals are telling you and to react to that and trust your gut. Where do we go from here? I think, we'll give it some time and we'll be jumping back in. The fundamentals of multifamily real estate are extraordinarily solid. There is demand for housing. There's not enough construction to keep pace. Construction costs are rising, which are placing additional value on existing housing stock.
Yep.
There are a lot of reasons to be in housing. There's no question about it, but there's also no rush to have to do it today. I'd prefer to see a little bit more predictability and definition to where interest rates are going and where rent growth is going. And I think right now it's a widely held belief interest rates are going up and may stay there for a while. What's not known is how far are they going to go up? Nobody really has a good handle on that. So that's one thing. But I think I can predict with some degree of confidence interest rates are going to be a little bit higher than they are right now and probably stay there for a bit. But rent growth, on the other hand, there's still forecasts being put out showing strong mid double-digit rent growth going into 2023 in a lot of markets that have just experienced 40% rent growth over the last 2 years and are just reaching a tolerance limit. And so, I feel like a lot of those forecasts are wrong and they're not going to pan out. And I'd like to see a little bit more definition of where that's headed. And I think we're going to find that where it's headed is lower. And right now, sellers are setting their expectations on the assumption that rent growth is going to continue the way it was. And they're basing their asking prices on that belief. And if that doesn't materialize, then you just paid too much. So I'm waiting for sellers to see that the golden days of rent growth are behind us and they need to adjust their pricing accordingly. And then it might be a good time to get in, but we aren't there yet.
Got it. Yeah, that makes a lot of sense. As you were talking, Brian, I kept thinking my question was going to be, why are you waiting then? If there's good demand and you see, because that is what I commonly hear is that, there's always going to be a demand for housing, obviously, but also like we're not building enough. So there's, going to be an undersupply. So some people feel like that means prices can't come down. And I'm with you where just because, maybe population's growing and demand's going up. I mean, there is a limit to what people can pay. I mean, people aren't going to pay half of their income on rent. So rent can't just keep going up. And I tend to agree with you, especially in the cities where they have seen incredible rent growth. Typically, history will say that will come down now because there's this general, if you look back and you zoom out, I think some, really smart people, some macroeconomists, just say that often, like zoom out. Don't look at what happened the last year because it's not enough data. Zoom out. And what you'll often find is like things like rent growth. Like you'll just see this, kind of a 45-degree angle. Rent typically goes up, right? Our government is devaluing our currency. And so, typically rent is just kind of going up. Well, if it suddenly shoots up at a different angle, what generally happens is it comes back down into that trend. So it's not like it's going to fall off a cliff, right? But when you go far beyond the trend, just like reverting to the mean, people talk about that and it's a powerful force. Like typically things revert to the mean. And I've been, just kind of following stuff. We're just here in, boring Cincinnati, Ohio, where, we don't explode like that, but, typically not so much downside. So I've been saying for a few years now, I'm a little, feeling like it's getting toppy and like, can't go up forever. So, Midwest is probably a good place to be in times like that. But looking at some of the hot markets where they'll run their, models kind of back to 2008 and say, hey, for the past, we're almost 15 years since then, so past 15 years, we've averaged 8% rent growth. The past couple of years, it's been 20% each year. So we're being really conservative and we're projecting that in the next couple of years, we only have 5% rent growth. And I can see what they're saying because that sounds conservative up against, 12 to 15 years of 8%. And the past 2 years, 20%. And we're saying we're going to come down to 5. But again, because you've had 20% for 2 years, you actually could go down below 0 for a couple of years and still average out to that 8%, right? Like that's where I think people can kind of get in trouble. I think that's what you're saying is that, and then to your point, Brian, until sellers see that they're coming down to 0%, why would they, they're not going to believe that. And a lot of people aren't. So they're going to sell based on, no, my pro forma says 5% rent growth next year and 5% the year after that. And that's us being very conservative, by the way. So I'm going to sell based on that kind of rent growth. But you're saying, I think you agree with me that no, you could definitely come down below 5% in those hot cities. And once the sellers see that and they can't go sell that bill of goods to the buyers by saying, no, we're going to be 5% when it's 0 for a year or below, then the sale price is very different. And that's what you're looking for.
Yep. You nailed it. I mean, that's exactly it. And, there's also, the concept that rents can plateau, right? They could just stay where they are for a while until kind of that mean catches up, that angular line you mentioned catches up to where rents currently are. That kind of thing can and does happen. And there was an article that came out recently talking about month over month rent declines in Phoenix, Arizona, which has been experiencing wild double-digit rent growth for the last couple of years for a good reason. I mean, there's a good reason why Phoenix rents have been climbing as fast as they have. And there's a good reason to a good story as to why they may continue to do so, but they don't necessarily do that in a straight line. They'll level off for a while. They might go down a little bit. I want to see more definition to where they're headed before I'm going to place my faith in, those kind of rampant increases continuing, because I just don't think they will. I think over the next couple of years, you might see areas like your area in the Midwest outperform some of the hot Southeastern U.S. markets on rent growth basis. It's entirely conceivable that could happen, mostly because those Southeastern markets and, Arizona and, Las Vegas and markets like that just need to take a breather, and then the fundamentals of those markets will catch up. And ultimately the markets where people are moving to will outpace everywhere else in the US and will produce the highest long-term rent growth. But in the very near short term, markets that have had tremendous run-ups may get beat out by what some might call sleepier markets in rent growth in the short term. So it's going to be interesting to watch how that plays out.
Brian, I love to hear that. I'm going to highlight that part of the episode. This has been the best part of the episode so far.
Yeah, well, the only problem is all good things come to an end, and eventually that trend will change, and you'll see that those popular markets will ultimately win the day. But for right now, some of the sleepier markets may produce some interesting and fun to watch results.
We'll take it. Brian, so one thing I've got in my mind, as you're talking before about, hey, kind of on the sidelines, I've got to think some of your investors are banging down your door, wondering what to do with their cash while they're waiting on the next deal and maybe feel like they're getting beat up by inflation. Are you experiencing some of that? And what are you telling them?
Yeah, we are seeing that. I mean, our inbound call volume is still pretty high. People wanting to invest with us for the first time, or people wanting to invest with us again. We have a lot of demand for the investment products that we've been putting out. But our story remains consistent that we don't feel that this is the right time to place capital. And the funny thing is most of the people that we talk to really get it. And they say, well, that's why I want to invest with you, because you understand that, right? You're not the one that's out here saying like, everything's great. Now's a great time. We just bought this $100 million deal. Give us your money. And by the way, we did it with bridge debt and, and all this other stuff. I mean, they recognize that we're trying to make really good decisions here, and that really does a lot. But at the same time, we also are looking for, what else can we do to provide returns for our investors? And, right now we are actively working on that. in a real estate debt acquisition. And I feel that's a really good place to be, because now I've got somebody else's equity in first loss position. And so, this is more of a cash flow play and a protect the downside play than it is a, hey, let's shoot for the moon on upside play.
Yeah.
Now is just not the time to shoot for the moon. Now is the time for capital preservation, income, and having a little bit of safety.
Yeah. Yeah. Well, I couldn't agree more. Yeah. Really interesting, right? Just real quick, on the Fed, you see interest rates going up. You think they can hold that? I mean, history will show a lot of times that the Fed, I think it's something like the max time from the time they start raising rates to the time they quit, or the time they reverse and start lowering rates, and I think QE and QT is involved in this as well. Like from the time they start QE, like I think 3 years is the absolute max that they've been able to hold out. I mean, following worldwide stuff like the Bank of England pretty much already like totally reversed course and have stopped their QT. You think the Fed can keep this up for a while? You think markets can handle it? Or do you think, early next year already, they have to stop raising rates and maybe later in the year, next year, they have to lower rates again?
Well, if you look at some of the forward interest rate curves from some of the really smart interest rate folks, there's a lot of predictions that rates are going to come down next year. I tend to think they're not right, and that doesn't mean I'm smarter than them. They're a hell of a lot smarter than me, but I just don't think that rates are going to come down quickly the way some people have believed that they will. It could take a while for this to unfold. I mean, rates still really, they aren't that high. I mean, when I bought my first house in 1991, my agency mortgage rate from Fannie Mae or whatever was 8.5%. And, that was a good deal back then, and I had a buy down where I could, for an extra like quarter point, I could get this buy down where the following year it would go to 7.5. And, there was this whole thing. So, now rates got into the twos, and that was kind of crazy. But when inflation is at 8%, even a 6% interest rate is a negative 2% real rate. Right. Sure. So, they're saying, rates have to get above zero. And so where is that? I don't even know where that is, because there's so many differing opinions. Right? Yeah. What is inflation? That depends on who you ask. Well, if we calculate it this way, it's 8%. If we calculate it this way, it's 12%. If we calculate it this way, it's 4%. Everybody has their own motives for the way they're calculating it.
Right.
And so, which one are they really comparing to? And is inflation year over year or month over month? I mean, it's like, okay, we had this big run up, but now it's not doing that anymore. But because it takes 12 months for the percentage to, really come into, to get normalized, it can be higher than it actually is for a while. So there's a lot of uncertainty there. And so I think that, rates could go higher than they are by a percent or two, and they could stay there for a year or two. Now, I think, you get after that, and, maybe things are going to need to calm down a little bit. If they cause a recession, they might have to come down, substantially. So I just don't know, which is a lot of the reason why, we're watching the game from the grandstands. We kind of want to see who starts, leading in the points before we place a bet on the winning team. Investing is about predicting probabilities, right? I mean, when you're investing in something, you're basically making a bet. You're putting your money down on a bet that something is going to happen. And you're making that bet because you're evaluating the probabilities of, what direction is rent growth going to go? Where are interest rates going to go? Where's real estate value is going to go? What demographic shifts are at play? How are rent payments going to come in? That was a thing with COVID, right? Are people even going to pay? So, there's all those different things that you have to try to, understand in your mind before you place that money down on that bet. And, right now there's a lot of variables that are a little bit less than predictable, so to speak.
Yeah, no, absolutely. Yeah. Good stuff, Brian. Thank you for that conversation. Really helpful as we think about, where things are headed and how we ought to think about it and how we ought to position ourselves. As we wrap up here, I always like to ask my guests, just what would you say is the key ingredient to being a successful real estate investor? Maybe let's talk about being a passive real estate investor. What's the key ingredient to having success there?
the key ingredient to being a passive real estate investor is having the cash to invest in passive opportunities. That's the tickets to the game. But aside from that, I think the key ingredient is a good partnership with a variety of people that can help you accomplish your goal. So what that means is you're much more successful as a passive real estate investor if you've got 4 or 5 or 6 really competent real estate sponsors that are investing in a variety of product for you to make good investments in, and having diversification. So you have a number of different sponsors. They might be investing in different things in different places so that you have diversification, because that really is, you're asking earlier about, well, how do I know if I'm investing with the right person? Well, you'll never 100% know. So it's always advisable to spread your money around and make sure that there's no single point of failure. And so, having a number of people that you can align with to help you accomplish that goal is going to make you much more successful over the long run than just throwing darts at the wall.
Yeah, no, absolutely. And and I would love to get into this conversation a little bit more, but just thinking of your family, Brian, and your life outside of real estate. I like to ask my guests as well, like, what's the key ingredient to having a successful life? I would like to think of it like maintaining your priorities while having success in real estate. Maybe what are some things that you've done to, or how has real estate been helpful or hurtful in making sure you're having success outside of your real estate business?
I think it's important for, partners to support each other. That makes a really big difference, and to be a good listener and collaborative decision maker about the direction that, your family's going, because, even though this is a business, it's still a family business, right? I mean, you're producing, you're making a living for you and your family, and you want to be on the same page. And I know that's not possible for everyone. It's difficult for some couples and families because they differ in their opinions on where things should go. And I've been very fortunate. We've been married. My wife and I have been married for 33 years, and we've been together for 35. And it's like, we've been able to do that because we support each other's pursuits and decisions, and and we try to be as collaborative as possible, and that really makes a difference. I think having a good balance of taking time for each other and communicating well, and just that one-on-one communication every single day is really what it fuels me. I mean, it's what really helps me achieve the level of success I have, is that, that level of communication has been there, and the support's been there.
Yeah. Real quick, Brian, what was it like when you were ready to leave your full-time job, to leave the W-2 and go out on your own? How did your wife feel about that? Is she less risk adverse? So maybe didn't like that felt scary to her, or had she seen you do it long enough and seen the success and was ready to do it? Or how was that between you and her?
It was an agonizing decision for me because I was getting a government paycheck with paid vacation and holiday pay and a pension and all of that stuff, right? Health benefits. My wife's much more risk averse than me. I'm far more into taking risks than she is. And so that was an interesting discussion, but it had gotten to the point where she actually was the one that brought it up to me, saying, it's probably time for you to, to hang that up, because it's getting in the way of what you're trying to do. And it's, I think you might be losing money by continuing to work. And I resisted for a while, because it's like, gosh, this is a steady paycheck, and what if this doesn't, go so well? And it was difficult. Getting a job in a police department is not an easy thing to do. I mean, you got to go through so much background checks and polygraph examinations and so many different things that it's not like you quit and then you go, well, that didn't work, I'm just going to go back, and you fill out an application and you're back in. I mean, it's not like that. It's like, once you close that door, it's locked. It's closed and locked. And so I guess Tony Robbins said it, right? If you want to learn how to get off the island, you got to burn all the boats.
Yeah.
Well, that burned the boats, and now I had to succeed. And maybe that was a driver for me that actually, pushed me to make sure that I made this happen.
Well, yeah. What a benefit for you to have a wife that would be that supportive and see it and kind of be ready to bet on you, maybe even before you were. So, tremendously helpful to have that.
It took a while, it took a while, and we had to see some real results. We had to see some real results. It's not like we were like, oh, I got into this business, 6 months ago and now I'm out. It's not like that.
No. Well, good stuff, Brian. I always like to get a book recommendation, but I definitely want to, just tout your book, The Hands-Off Investor. We'll put that in the show notes and a link to it. It's a great one. So I think people should go there. Brian, I know you're pretty active on LinkedIn. Where should people go to find you?
Yeah, they can find us at praxcap.com. It's praxcap.com. It's our company website. You can also find me on Instagram at Investor Brian Burke. Yeah, biggerpockets.com. I'm in there answering questions in the forums frequently. So every once in a while, I'll pop in over there and add my 2 cents worth. But if you want to know what's in this brain, it's in 350 pages in the Hands-Off Investor. Kind of everything I know went in there. So
that's awesome.
That's a full brain download right there.
Yep. Good stuff. We'll put all that in the show notes, Brian. This has been really, really enjoyable for me and my listeners, I'm sure, as well. Thanks so much, Brian. Before I let you go, I always like to ask our guests, before I let them go, how might my listeners and I be praying for you in the coming weeks?
Well, I think in the coming weeks, just pray that I don't get myself into any real estate deals, because there's no reason. There's no reason to do that right now. So outside of that, I'm in pretty darn good shape. So I have right now nothing to worry about. You're just working on
your golf game right now, right?
That's what I've told people. They ask me, "Are you a buyer or a seller right now?" I'm like, "I'm a golfer. I'm going to go out and I'm going to improve my golf game." So there you go. Pray that I can actually figure out how to hit a golf ball. That would be, that's probably what I need more than anything else right there.
Yep. All right. Yeah. We'll pray for that. Yeah. Rest and recovery, some R&R during this time. Hopefully, means some good time with your family and all that, and then get ready for maybe it gets busy again next year or the year after.
Oh, it will.
Cool. Well, thanks again, Brian. It's been really, really helpful. Appreciate you coming on. Take care.
Pleasure, Lee. Thank you.
Thank you for joining us for another great episode. I hope you'll take action on what you've learned today. If you enjoyed today's show, please consider leaving Lee a 5-star rating and review. And check him out on threefoldrei.com. Until next time, 1 Timothy 6:17.